Jay Powell's going to have his work cut out working with Scott Bessent, to try and, sort of manage some sort of stability in really what's going to be a crisis. Because, the worst possible thing from the point of view of a Keynesian, which is what we have, or neo-Keynesian macroeconomists, is something which they just don't understand. They think that you get a recession, interest rates go down, prices go down. No, they don't. What we're looking at is a recession, and at the same time, rising bond yields, rising interest rates. It's a real killer, and that's the whole point about the biggest credit bubble in history going pop.
Today's update highlights a sharp rise in gold discounts across Asia, with India seeing levels not observed in nearly 9 years. Soaring prices have discouraged buyers, pushing Indian gold dealers to offer markdowns of up to $80 per ounce, compared to the domestic rate, which includes a 6% import tax and a 3% sales charge. This is the steepest discount since July 2016. Just a week ago, the markdown had reached $74. The high cost of gold has slowed down jewelry sales, as buyers hesitate and retailers across the country feel the pressure. According to Surendra Ma, Secretary of the India Bullion and Jewelers Association, customer activity has noticeably dropped. A Mumbai-based dealer affiliated with a private bullion importing bank mentioned that jewelers are refraining from placing large orders, citing fewer pre-bookings ahead of the Akshaya Tritiya festival. We're about to roll the top highlights from our latest interview, but before that, make sure you're subscribed, have notifications on, and don't forget to check out our brand new numismatics guide so you never miss a beat.
It quite simply is the destruction that he has wrought on markets by, as I said earlier, every time he talks about China, he seems to he says, I'm going to make it 245% tariffs. Hold on. This is a man who actually doesn't understand what, his responsibilities. And not only that, but you have all these executive orders coming out of the White House, which, has he really got the power to do this? You sort of think this is not actually, basically he's doing things that Congress should be doing. If Congress passed these policies, which I would very much doubt a lot of his policies, that's actually their responsibility, not the president's. He's weaseling around the law to basically take total dictatorship over American policy. And his latest example of this, of course, is on interest rates. He's trying to take it away from the Fed. This is just so dangerous. And, I think that he has been sat on because quite clearly he's quietened down. And I think he's just been told, look, shut up. When you've now got to ask yourself the question that having sort of embarked on this fairyland idea that he could replace income tax with tariffs and so on and so forth, like they did before the First World War or whatever, what's going to happen now? That's obviously not going to happen.
What if I told you your computer could earn you crypto while you're gaming, working, or just watching YouTube, and you didn't need to spend a single dime?
Whether there is going to be any increased revenue from tariffs, we'll have to see. But there's a huge question mark over that. What's going to happen now that he's really given a kick into a recession? He's just kicked the economy downstairs. What's going to happen to the budget deficit? It's going to rise, isn't it? Can he cut taxes? No. If he tries to cut taxes, he'll get punished. It's simple as that. He no longer has the power to do this, because I think that Bessent and his officials have now got his measure. Trump has basically made the mistakes. He has proved to be totally incompetent in terms of fiscal policy, in terms of economic management, and even politics, I would say. He's just basically bullied his way through. So now that the state is getting Trump's measure, this is not quite so nice. I think the deep state basically is getting back into power, if you like. So we go from Sleepy Joe to Sleepy Trump. This is going to be, I think, the way it goes, because, if you start losing, if you're in a position of power, a total power, and you start losing it, because you've made some fundamental errors, basically you're on a downhill slope. In terms of losing that power, you just lose credibility. And the loss of the president's credibility will affect the loss of the dollar's credibility. And as I say, we've got this huge, great credit bubble, the other side of which is debt, and it's debt that everybody's looking at, abroad anyway. And you can see that, if the debt is going to be a problem, which basically means that the cost of debt in the form of interest rates is going to have to rise in order to sustain that debt, as it were, then under those circumstances, what does that do to the economy? The economy starts falling apart because it cannot afford higher interest rates because it's full of zombie corporations. The level of interest, annual interest cost on the federal government is already greater than the entire defense budget. Everything starts going wrong. And this is the problem. And I think it's even too early to say that with the state, if you like, the permanent establishment, helped by people like Scott Bessent, who's actually a pretty sensible guy, trying to sort of calm things down, I don't think it's going to work, because we're popping a credit bubble as well as dealing with the trade tariff uncertainty.
Meanwhile, silver has surged to nearly $33 an ounce, holding steady during Wednesday's North American session. The metal's strength follows reduced concerns over a potential U.S.-China trade war after President Donald Trump expressed confidence in reaching an agreement with Beijing. Speaking to reporters from the Oval Office on Tuesday, Trump said talks with China are progressing positively. While he noted that tariffs wouldn't be eliminated altogether, he clarified they wouldn't hit extreme levels like 145% either. Typically, as global economic fears ease, interest in safe haven assets like silver tends to weaken. Yet silver's rise is being driven more by its industrial utility. It plays a vital role in industries like electric vehicles, electronics, power transmission, and mining. Investors believe that improving U.S.-China relations will benefit both economies, boosting demand for silver. Additionally, a retreat in the U.S. dollar added support to silver prices. The dollar index, which gauges the strength of the greenback against a group of 6 major currencies, reversed earlier gains and dropped back toward the 99 mark. This happened even as Trump dismissed rumors about replacing Federal Reserve Chair Jerome Powell, although he continues to criticize Powell for keeping interest rates too tight. Now it's time to jump into the top moments from the latest interview, but before we do, hit that like button, subscribe if you haven't yet, and turn on notifications so you're always in the loop.
All financial markets under these circumstances. The US large banks are not as leveraged as they are in the EU or in Japan. And I think that there has already been a pretty good shift away from lending to small and medium-sized companies into lending to the government in the form of buying T-bills, that sort of thing. That's already, I think, happened to quite an extent. As far as the EU is concerned, I don't have quite the same feeling. I think that they have been starving business of credit. Japan, I haven't got much of a clue on, I must admit. But then, there's just such a huge government bond market in Japan. And I think that's really where so much of the commercial banking obligations are already. And of course, they get undermined by rising interest rates. we've seen a certain amount of disruption there in the past. That seems to have died down for the moment, but I suspect that a lot of that is because a lot of carry trade stuff has been basically washed out of the system by, if you like, the sort of Trump tantrum, the Trump tariff tantrum. The banks are definitely, in both the EU and Japan, are both definitely very highly leveraged. I'm talking about the big ones. And of course, the other thing we've got is we have got the over-the-counter derivatives, and also linked to it very, very much because there's the other side of a lot of risk being laid off. You've got regulated derivatives in the form of futures. Now, I can see that. I think what's happened is that when it comes to gold, the big banks have basically got themselves straight. I mean, notice how they now seem to be quite happy. Their analysts seem to be quite happy, saying, like, we forecast gold going to $4,000 or whatever it might be. And while I think it would be wrong to say that the analysts are very much in the pockets of the book, I think they would be quite restricted from that sort of comment if it was very much against the interests of the book. So I can only conclude that the big banks have basically got their gold positions straight. What we don't know is whether those gold positions are straight on the basis of paper or actual physical. I suspect quite a lot of it is physical, and I think quite a lot of the gold that migrated from London and Switzerland over the last 2 months into COMEX warehouses is part of that physical build-up, I think, for some of the larger bullion banks. But if you do get a crisis in the precious metal derivatives, then that is going to impact, I think, the entire over-the-counter derivatives system. And there we're talking about potentially trillions. So, yeah, I mean, it's very easy to underestimate. I mean, we've seen the dollar fall on a trade-weighted basis by something like, 10, 11%, I think, in April. And that fall, you sort of think, well, okay, so what? But think about the quantity of dollar credit in issue. It is absolutely enormous. The consequences of that 10% fall are very, very substantial. Going from, what the foreigners actually own in terms of financial assets in the US, and on top of that, of course, we also have all the derivatives. I mean, that's absolutely enormous.
Let's talk about Alasdair's belief that wealth is often created when sentiment is down and opportunities go unnoticed. Do you think we're at the start of a new commodity boom, as Macleod argues, driven by a long period of underinvestment and limited supply? Or are we simply hitting a short-term peak before a larger downtrend takes over in gold and silver? More importantly, how are you positioning yourself right now? Drop your thoughts in the comments. I'm reading them all. Also, check out this next video. It's exactly what you need to see right now. Catch you there.